Hello everyone, welcome to the next lecture of Banking Final Accounts. In the last lecture we studied the provisioning norms requirement in case of a bank, something like bad debt reserve. We studied various percentages for standard assets, substandard assets, doubtful and loss assets, and we also studied the income recognition norms. Now the same point will be repeated in the current lecture also with one new element, that is, what is the provisioning for advances to be done if the loans and advances are covered by ECGC or DICGC guarantee. All of you look at page 5 of your study material, you'll find in that. And after I read this paragraph, I'll make you write the format in which you would solve the related practical question. And then mixed example also will take up today, which includes this ECGC guarantee also, plus the provisioning requirement we studied in the last lecture also. So look at it everyone, be attentive. In the case of advances guaranteed by Export Credit Guaranteed Corporation, okay, ECGC means Export Credit Guaranteed Corporation, or DICGC means Deposit Insurance, okay, and Credit Guarantee Corporation, DICGC, Deposit Insurance and Credit Guarantee Corporation. Provision is required to be made, okay, provision is required to be made only for the balance amount of advance outstanding in excess of the amount guaranteed by the corporation. Means whatever amount is guaranteed by the corporation that we are going to get from ECGC or DICGC. So for that amount, provision is not required. Okay. Further, in case the bank also holds a security, okay, in case the bank also holds a security in respect of advance guaranteed by ECGC or DICGC, then the realizable value of security should be deducted from the outstanding balance before the ECGC or DICGC guarantee is set off. Okay, that means what? Understand it. You can write this in your notebooks now. Give the heading in your notebooks, everyone. ECGC. Okay, give the heading in your notebooks. ECGC or DICGC guarantee. Okay, this heading all of you give in your notebooks, ECDC or DICGC guarantee. Now what they say here is, if the bank also holds a security, then the realizable value of security should be deducted from the outstanding balance before the ECGC or DICGC guarantee is set off. Means whatever is the outstanding balance of loan. Okay, first you would write the outstanding balance of loan, and they say, all of you must be writing this in your notebooks in the summary. Okay, in the summary, whatever is the outstanding balance of loan, from that first we will subtract realizable value of security. If any security is given to the bank by the person to whom you have given the loan, then whatever is the realizable value of the security, okay, whatever is the realizable value of that security, first you will subtract that. Okay, whatever is the realizable value of security, first you will subtract that. Okay, look at that blue highlighted once again. In case the bank also holds a security, the realizable value of security should be deducted from the outstanding balance before the ECGC or DICGC guarantee is set off. So from the outstanding balance, first we'll subtract realizable value of security. Then look at that yellow highlighted one. In case if the amount is guaranteed by ECGC or DICGC, then only for the balance amount of advance outstanding in respect of the amount guaranteed by the corporation. Means this provision is required. What do they say? This provision is required to be made only on the balance amount of advance outstanding in excess. Okay, look at this once again. In excess of the amount guaranteed by the corporation. So whatever amount is guaranteed by the corporation, that again we will minus. From that you will subtract ECGC or DICGC guaranteed. Okay, whatever amount is guaranteed by them, that again further we will subtract, because on that amount no provision is required. On this amount, okay, on this amount no provision is required as per the banking rules. As we studied, look at that highlighted once again. What is it given in the yellow highlighted? Provision is required to be made only for the balance amount of advance outstanding in excess of the amount guaranteed by the corporation. Means whatever amount is guaranteed by the corporation, on that no provision is required, and remaining you can say is totally unsecured amount. Remaining you can say is totally unsecured and unguaranteed amount. Unsecured as well as unguaranteed amount. Okay, because if you consider, then this amount is also unsecured, but then again out of that some amount is guaranteed by the corporation, that you'll minus. So whatever remains is unsecured as well as unguaranteed. So basically on which amounts the provisions are required? This amount the provision is required, and this amount the provision is required. Okay, even the secured amount provision is required. We studied in the last lecture that whatever are the secured amounts, on that also we have to create the provisions at the respective rate. In case of substandard assets, we studied 15% provision for the secured amounts. Even in doubtful assets, if the secured amount is outstanding up to 1 year, 25%, 1 to 3 years, then 40%, and more than 3 years, then 100%. Okay, we have studied that in the form of chart also in your notebook, that even in case of non-performing assets, substandard secured amount 15%, and in case of doubtful assets, secured up to 1 year, 25, 1 to 3, 43, more than 3 years, 100%. So even on secured amount, what I mean to say is, even on secured amount the provision is required, and unsecured amount also the provision is required as per the rates we have studied in this chart. Whatever is unsecured, on that also provision would be required. But whatever is this ECGC or DICGC guarantee, on that no provision is being required. Okay, so what we shall be doing is, first we'll create provision on this secured amount. Okay, first we'll create provision on this secured amount. So write down in your notebook, provision on secured amount as per the number of years it is outstanding. Okay, so provision on secured amount will be created first, and then we will create provision on unsecured amount. On these two amounts only the provision will be required. On ECGCD or DICGC guaranteed amount, no provision is required. So then we will create provision on unsecured amount, and that will be the total provision required. So all of you must have written this in your notebooks. Now take out your practical questions. We'll be taking up with 3 questions in the video lecture, and then 3 more similar questions you'll be trying in homework on your own. Take out your study material, everyone. We'll start with the practical questions. Yes, all of you should have taken out the practical part of study material now. As I said, 3 questions I'll solve in this video lecture. Question number 4, 5 and 16D of your university paper set. Okay, first we'll be solving question 5, then we'll take up with question 4 and then 16D. And 3 questions would be your homework of your university paper set, 20C, 24D, 28D. Answers of these 3 questions will be provided in the You Will Learn app. So once you solve them, you can cross-verify your answers from the You Will Learn app. Okay. Now look at question number 5, everyone, be attentive. ABC Bank Limited had extended the following credit lines to a small scale industry which had not paid any interest, underline this, since March 2015. Okay, and this balance is outstanding on 31/3/19. Now March 2015 to 31/3/19 means, can I say more than 3 years have passed? Why I am telling you this? Because we have studied that if it is doubtful and more than 3 years have passed, Then even if the amount is secured, we have to create 100% provision. Even if the amount is unsecured, we have to create 100% provision. Okay, in case of doubtful assets, and even if they are secured, but the period is more than 3 years, so whether the secured amount is there or unsecured amount is there, in both the cases, we have to create 100% provision. Okay, so that's why this is important, that more than 3 years have passed. Now, two loans are there, term loans and export loan. DICGC or ECGC covered is 40% in case of term loan and 50% in case of export loan. Security held is also there, worth 15 lakhs in case of term loans and 10 lakhs in case of export loans. For this DICGC or ECGC covered, no provision will be required. Okay, whatever amount is guaranteed by DICG or ECGC, for that no provision will be required. Provision will be required only on these two amounts. Which amounts? Secured amount and unsecured amounts rather. Okay, so security held is 15 lakhs and 10 lakhs, but realizable value of securities is 10 lakhs and 8 lakhs, and we have to subtract realizable value. See, what did I make you write here? Realizable value of security, and see, even in this paragraph, the realizable value of security should be deducted from the balance. Okay, so even if the security is 15 lakhs but realizable value is 10 lakhs, will subtract 10 lakhs only. Even if the security is 10 lakhs but realizable value is 8 lakhs, will subtract 8 lakhs only. Compute the necessary provision to be made for the year ended 31/3/2019. So all of you give these two headings in your notebooks. One is term loan. Okay, we'll do it in columnar form. And the other one is export loan. Okay, one is term loan and the other one is export loan. Very first, we start with, as I made you write the table just now in the summary. Very first, we start with outstanding balance. So all of you write down in your notebooks, outstanding balance. Now in case of term loans, it is 35 lakhs and export loan, it is 30 lakhs. So all of you write down 35, and here you can write at the top rupees in lakhs. Okay, rupees in lakhs, or you write the entire units 35 lakhs, and here it is 30 lakhs. Now first, as we discussed in the format and the summary just now, first we will subtract the realizable value of security. Okay, realizable value of security. Now, what is the realizable value of security? 10 lakhs and 8 lakhs. So 10 lakhs we will minus here and 8 lakhs we will minus here. Now 35 minus 10, 25 lakhs is, you can say, unsecured. And 30 minus 8, you can say 22 lakhs is unsecured. Then we will subtract ECGC or DICGC guaranteed. Now what is ECGC or DICGC guaranteed amount? 40% and 50%. So all of you do 25 lakhs into 40%. That comes to 10 lakhs. That we will minus. Okay. 25 lakhs into 40% is 10 lakhs. And here 22 lakhs into 50%. Here 50% is guaranteed. So 22 lakhs into 50% means 11 lakhs is guaranteed. Now 25 minus 10. 15 lakhs is unsecured and unguaranteed. 22 minus 11. 11 lakhs is unsecured and unguaranteed. Okay. So as we discussed in the summary just now, provision will be required on secured amount of 10 and 8 lakhs and unsecured and unguaranteed amount of 15 and 11 lakhs. Whatever is ECGC or DICGC guaranteed 10 and 11 lakhs, on that no provision is to be created. So how will we create the provision? Understand it? Provision. First of all, on secured amount. Now, on secured amount, which is 10 lakhs and 8 lakhs, though it is 10 lakhs and 8 lakhs, but as we discussed, since the period is more than 3 years, even on secured amount it becomes doubtful asset, and for more than 3 years we have to create 100% provision. So this 10 lakhs 100% provision will be required, which is 10 lakhs, and this 8 lakhs also 100% provision will be required, that is 8 lakhs. Yes, had it been 2 to 3 years, then on the secured amount we would have created 40% provision, and sorry, 1 to 3 years, and had it been less than 1 year, then we would have created 25% provision, as we studied in the rules in the last lecture. And on unsecured amount we always have to create 100% provision only. So 15 and 11 full 100% provision. 15 into 100%, 15 lakhs, and 11 into 100%, 11 lakhs. So total 10 plus 15, 25 lakhs of provision is to be created. 8 plus 11, 19 lakhs of provision is to be created. Total provision required. Okay, so these calculations are to be done whenever ECGC or DICGC guarantee amount is given. Whatever is the amount guaranteed by ECGC or DICGC, on that the provision is not to be created. Only on these two amounts, realizable value of security, secured amount and unsecured amount, the provision will be created. Now look at question number 4, be attentive. From the following information, find out the amount of provision on advances for the commercial bank for the year ended on 31/3/19. Very first, packing credit outstanding from food processors is 60 lakhs outstanding, okay, against which the bank holds securities worth rupees 15 lakhs. So this is secured amount, that will minus first. And 40% of the above advance is covered by ECGC. On that, no provision is to be created. Whatever amount is guaranteed by ECGC, on that no provision is to be created. The above advances have remained doubtful for, now same thing, more than 3 years. So 100% provision will have to be created. Okay, here also why did we create 100%? Because it was outstanding for more than 3 years. Here again more than 3 years, so even secured amount 100% and unsecured assets we have to create always 100% provision. Other advances, let us recollect and write the rates. Standard advance, if it is in agriculture and SME sector, it was 0.25%. All of you must remember that. I told you agriculture and SME 0.25. Then RERA, real estate 1%, R residential 0.75%, and all others 0.4%. Okay, you can refer to this chart. RERA, agriculture and SME, just now what we did, 0.25%. Then RE, real estate and commercial 1%, R residential 0.75%, and all others 0.4%. So just now what we have is advance to commercial and real estate sector 1%, all others 0.4%. Substandard. Now in substandard we discussed that if it is secured then 15% provision, and if it is unsecured, and within unsecured if it is covered by escrow account then it is 20%, otherwise it is 25%. Nothing is mentioned, so 25%. Okay, all of you must remember that chart. Secured 15, unsecured, safeguard, that is escrow account 20%, and others. Just now we have this situation, unsecured and others, escrow account is not mentioned, so 25%. And in doubtful, unsecured always 100%. Within secured up to 1 year, 25%. 1 to 3 years, 40%. More than 3 years, 100%. And loss assets, 100%. Okay. So all of you must be able to remember these percentages. Then only you can solve the example perfectly well. What we will do is first we'll solve this first portion, and then second portion and first portion joint table will be made. So first, as we did just now, let us make the calculation and find out the provision required for this packing credit outstanding from food processors. Give the heading in your notebook. First we calculate for packing credit. Okay, first we calculate for packing credit. So how do we start? We start with outstanding balance. The format which I made you write, we start with outstanding balance. What is the amount of outstanding balance? 60 lakhs. So we'll start with outstanding balances of 60 lakhs. You can write rupees in lakhs. Now first we'll subtract realizable value of security. Okay, first we will subtract realizable value of security. What is the realizable value of security? 15 lakhs. Okay, you can see in this yellow highlighted security is worth rupees 15 lakhs are there. So from 60, 15 lakhs are secured, means we can say 45 lakhs are unsecured. Okay, 45 lakhs are unsecured. Further, ECGC guaranteed is 40%. So that will minus less ECGC guaranteed 40%. So 40% you'll do of this 45 lakhs. Okay, 45 lakhs into 40%, that is 18 lakhs is ECGC guaranteed. So 45 minus 18, 27 lakhs. You can say is unsecured and unguaranteed. Okay, that is unsecured and unguaranteed. Now, what is the provision required? How do we calculate it? Okay, provision required. Give the heading provision required. As we discussed that on this ECGC guaranteed, no provision is required. Provision will be required on which two amounts? Secured amount of 15 lakhs and unsecured and unguaranteed amount of 27 lakhs. So secured amount, since it is again outstanding for more than 3 years, will create 100% provision on this 15 lakhs. So 15 lakhs into 100%, 15 lakhs. And unsecured, we always create 100% provision. So unsecured amount, which is this 27 lakhs. On that again we will create 100% provision. So 27 into 100%, 27 lakhs. 15 plus 27, 42 lakhs is the total provision required. Okay, this is the total provision required in which situation? It is required in case of packing credit. Now we talk about the second one. So for second one, we'll make the whole table. So if we make this table showing provision required to be shown in P&L account for the second one, columns assets, amount rupees in lakhs, percentage provision, and amount of rupees in lakhs provision. Pause the video and make this format, everyone. I hope everyone would have done this format. Now listen carefully. Very first, on this standard agriculture and SME sector, we have to create 0.25%. So give the heading. Very first is this standard amount. Within that, agriculture and SME sector, amount is 500 lakhs. Loan is 500 lakhs and provision of 0.25% is required. Okay, so 500 lakhs loan, 0.25% provision. 500 into 0.25% provision, everyone calculate it. That comes to 1.25. Okay, then after agriculture and SME sector, we have commercial real estate sector. Okay, commercial real estate sector, RERA. So RER, RE. Commercial and real estate sector, the loan given is 2000 lakhs, and for that we require 1% provision. So 2000 into 1%, that is 20. Okay, then after commercial and real estate sector, we have all others 500 lakhs on which 0.4% provision is required. So all others 500 lakhs. 0.4% provision on 500 lakhs would be 2 lakhs. Yes. Okay. Then we come to substandard assets. Now within substandard, what we have is secured 1000. On that 15% provision is to be created. So secured 1000, 15% means 150. Then unsecured. Now unsecured is 1200. On that 25% provision is to be created because it is not mentioned also that it is safeguarded by escrow account. So 1200 into 25% is 300. Then after unsecured, doubtful assets. Okay, we have doubtful assets. Now within doubtful, whatever is unsecured, on that we have to create a 100% provision only. So what is unsecured amount in doubtful? 200. On this 200 lakhs, 100% provision is required. That is 200 lakhs. Okay, unsecured amount 100% provision, so 200 lakhs. Now whatever is secured amount, within that it depends. So first amount is up to 1 year. So up to 1 year amount we have to create 25% provision on 900 lakhs. So up to 1 year 900 lakhs, 25% provision, that is 225. Yes. Then 1 to 3 years. Now whatever is doubtful up to 1 to 3 years, on that 40% provision is required. So 1 to 3 years is 1000. 1000 lakhs, 40% provision is required. So that comes to 400 lakhs. And whatever is outstanding for more than 3 years, on that again 100% provision is required. So on that more than 3 years outstanding of 100 lakhs, 100% provision is required. So all of it write down 100 lakhs, 100% provision, so 100 lakhs. And then we have loss assets. On loss assets, always 100% provision is required. So on this 600 will require 100% provision. That is 600. Now the total provision required. Let's do the total. 1.25 plus 20 plus 2 plus 150 plus 300 plus 200 plus 225 plus 400 plus 100 plus 600. So 1998.25 lakhs. The total provision to be created is 1998.25 lakhs. Okay. So these are the provisioning requirements. For the first one, packing credit, the provision required is 42 lakhs. And for the second one, all other advances, the provision required is 1998.25 lakhs. Okay. Now, this question of examinations, question 16D, all of you will be trying on your own. I'll discuss it with you and all of you will be trying it on your own. So be attentive. Take out the university paper sets, question number 16D, everyone. You are required to calculate the provision from the following information. Outstanding balance is 8 lakhs. Now this ECGC cover 50%. No provision will be created on that because it is covered by ECGC or DICGC guarantee. Then period for which the advance has remained doubtful is more than 3 years. So again, more than 3 years means whether secured or unsecured, 100% provision will have to be created. Doubtful as on 31st March 15. Security held. So security held 3 lakhs you'll subtract in the beginning, and then secured also you'll create 100%, and unsecured and unguaranteed also you'll create 100%. All of you pause the video and try this question entirely on your own, and then you play the video and you'll find the solution in front of you. All of you try this question entirely on your own just now. I hope you all would have done the solution. Check your answer now. Be attentive, everyone. First, we'll start with outstanding balance of 8 lakhs. From that, we'll subtract the secured amount of 3 lakhs, so 5 lakhs will remain. And then on that 5 lakhs, we'll create 50% ECGC guaranteed amount, 2,50,000. So unsecured and unguaranteed is 2,50,000. On this 3 lakhs secured amount, since it is doubtful for more than 3 years, 100% provision will be created, 3 lakhs. And on this unsecured 2,50,000, we always have to create 100% provision, 2,50,000. Total provision required is 5,50,000. I hope everyone is able to get this correct. Now you all will be trying 3 questions entirely in homework 20C, 24D and 28D. And answers of all these 3 questions will be uploaded on You Will Learn app. Okay. Now next lecture we'll be starting with the main question of final accounts. So in the next lecture we'll be covering the formats. Attend that lecture carefully. We'll be covering the formats of profit and loss statement and balance sheet. That will be all for this lecture. Bye everyone. See you in the next lecture. Take care.